Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is April the 23rd. I'm delighted today to be joined by Janiv Shah, Vice President, Oil Markets, Refinery and Crude Balances Lead at Rystad Energy, Ram Narayanan, Director, VP, Strategic Market and Business Development at Vedanta, and Rob Barnett, Senior Global Energy and Commodity Analyst at Bloomberg Intelligence. Thanks so much, gentlemen, for joining us this morning. Let me start, Rob, with you perhaps, just to give us your perspective on whether you agree with this sort of what we're seeing and why. Oil markets seem to be steadying more and more as time passes, despite supposedly escalating tensions in the Middle East. How do you explain how the market is interpreting the events of the last week, and do you expect that relative calm to continue?
Yeah, so I think that the oil price has a lot of upside potential if there is an enduring conflict. Our team put out a note talking about the potential for much higher oil prices that than we're seeing today. 150 a barrel under a broad Middle East conflict with massive implications for GDP hit. We're talking over $1 trillion, and that could be damaged if the conflict escalates. So there is a big upside case from where we are today, but the market seems to be betting on peace, it seems, and I certainly, on a personal level, think that would be a great outcome. And when we look at the fundamentals for the oil market, before the sort of latest elements of the conflict escalated, we thought that the market looked relatively balanced, just sub $90 a barrel. So I think that, when you look, if you run a very typical fair value model, look at all of the economic factors that you could put in and sort of set the geopolitics aside, there are many things about the market that make a lot of sense based on just the fundamental factors out there. So I think the market seems to have shrugged off the geopolitical element largely, and hopefully that's a signal of more stability in the region.
Okay, thanks, Rob. Yeah, it seems to be betting on de-escalation, despite what we're seeing and what we're hearing, perhaps from various sides of the conflict. Thanks, Rob. I mean, Ram, let me go to you on the fundamentals then, and demand, and what the picture looks like, particularly coming from Asia, including Chinese demand. We're getting sense that it's a slightly rosier picture for China in terms of its outlook for the year, i.e., it could achieve that 5% growth that people were cynical about only just 2-3 months ago. What sort of sentiment are you feeling there from Asia, including India, of course, and other big consumers?
Yep, I think first let me talk about China, because why I'm talking about China is because the commodities prices apart from oil have all moved up. Take aluminum, copper, zinc, mainly because of China. So China, 5% growth, as you rightly alluded to. I think they achieved 5.2% last year. And a lot of rosier, a lot of good news that's emanating out of China. But, when you look in the fine print, exports has been affected in the month of March. And a good amount of imports of commodities went into China. When I look at the first 15 days numbers for April, I believe it's lower. So frankly, I'm not I'm not gung-ho about China. Neither am I as pessimistic about China as I was last year about China. So I'm sort of neutral. So when you look at the April and probably the May numbers, which is a peak economic season for China, to really take a bet on what's going to happen in China, whether they're going to achieve a 5% growth rate or it's going to drop down to 4.5% or something, that's what we need to look into. So, but still, there is a lot of euphoria about China, which I'm not sort of agreeing to that. That is number one. Coming to India, like we are in the peak of the election season, the voting has started, but the picture looks pretty good. In fact, the present government is so confident that they have asked all the ministries to make a 100-day plan. So, and the markets are also sort of agreed to it. So therefore, the picture for India looks pretty as good as it was before. So therefore, I think India should achieve its numbers, 6.5, 6.8%, as we saw a few days back. So it should achieve its numbers. So I think coming from China and India perspective, China, I'm a little bit neutral. India, I'm what are numbers which they talked about is going to be achieved. But coming to the market fundamentals, I think one of the major reasons why we not seen a spike in the oil prices after last week incident is there's already a big amount of premium that's built up into the market, maybe $15 or $18 or whatever it is. And second thing is, like, it was expected that the US would not allow it to go into full blown war, given the fact that Joe Biden is facing an election here. He doesn't want gasoline prices to go up right now. So I'm sure there's a good amount of diplomacy is going on, so it doesn't go into a full blown war. And looking at the way these so-called attacks have happened, it's more like ego satisfying both the parties. So I think that's where markets have shrugged it off, and oil has come to 86, 87 as compared to 90 on the day of the attacks. So that's my reading of the market.
Thanks, Ram. Thanks for that. Janiv, welcome again and good morning. Ram just mentioned how much the market's premium has built into the price already from before, for the last few months. One comment we're getting is that actually the market should be more concerned about Russia and Ukraine than the Middle East tensions that we're seeing, because that's where there's real impact from product flows, what Russia's doing with that, attacks on Russian refineries, etc. Give us your take on that sort of refining risk, if you like, to any particular, any geopolitical, whether it's passage, waterway choke points or to actual, attacks on refineries and sanctions, let's say.
Firstly, thank you, and great to be back here. I think what we're mentioning within the market is that it's very much regionalized, and it's a fractured market. You can look at regions essentially running in terms of refineries for product make for themselves. Europe, of course, is in the hole that it has been in. Diesel stocks have been fairly built up, but through the summer period with demand building up, that's something that could reverse. But you mentioned an interesting point here with the Russia-Ukraine tension. Now, with the recent drone strikes and the flooding of Orsk refinery, which has since come back online in reports that we're hearing and speaking with members on the ground as well, it's an interesting dynamic where the amount of diesel being produced has, of course, dropped. Russian refinery rates are at the lowest point in sort of nearly 11 months. Which is something that's concerning as we ramp up into the summer demand season or just pure demand season globally. You're looking at secondary markets where Russian diesel and other products can flow to, in the likes of Brazil, North Africa, and a few others, where demand is slowly picking up for these middle distillates. And then if you consider what's happening within the Brazil refining system of the number of outages, especially through key refineries, sort of 6 refineries going offline, is now 11. So the amount of middle distillates being produced on the ground in terms of supply has reduced drastically. There's another tension, there's a simmering tension, of course, within the Middle East with the amount of crude flows. We've talked about products for a second, but if we talk about crude, of course, with the Iranian market and how many Iranian barrels can potentially come onto the market with these US sanctions coming further online, it's not going to impact anyone more than China. So, the world in terms of the refining sense for the next few months does center around what China does, what China can do. And of course, with the crude and product flows market, indeed.
Okay, thanks, Janiv. So yeah, still all eyes on China at the end of the day, at least for that marginal barrel, right, of demand, and also even in terms of its own product exports, of course, which will influence those crude imports. And of course, Rob, just back to you, another big part of the Chinese activity is based on, what's happening in the West in its export market, right? And how those economies are doing. And we have seen an uptick in industrial activity in China in the first quarter on those trade exports. Perhaps because we're still seeing a really rosy picture, especially in the US. Where are we on that front? We've just seen headlines coming out saying, oh, actually, not only are we not going to have rate decreases this year, possibly, we're going to possibly be looking again at another sort of a marginal uptick in rates because of this sort of US economy that still seems to be in full swing. What are we missing here?
Well, first, let me just comment, if you don't mind, to go back on the geopolitical risk premium in the oil market. I'll just offer a quick anecdote on that, and that's just that we regularly run surveys amongst our clients and sort of get a pulse on that kind of thing. And 92% of survey respondents to a recent one we did said there's less than $5 risk premium in the oil market. And of course, there's no right answer to this question, but I think I would just say that we see the geopolitical factors as present, and this was before the recent escalation of the conflict. So but the price is kind of sideways since then. So I think that at least when we check in on that, we don't see extreme level of geopolitics risk built in, at least at the moment. Now, onto your question on what's going on with U.S. economy. Well, look, I'm based in the U.S., so I'm certainly hopeful for a strong economic environment, and I think we keep seeing the U.S. economy deliver, and I think it's very challenging to pin down when and if there's ever going to be a recession. And my general sense is that we're seeing more concern in the U.S. about the continued threat of inflation, which is influencing all of the discussion around interest rate policy, and the factors that most folks are talking about are much more about getting prices stabilized than concern about general macroeconomics here at the moment. And generally, that's a positive sign, I think, just generally for the economy.
And what about, just stick with you, Rob, just on the gasoline front? We've seen those prices sort of edge a bit higher, but compared to this time last year, ahead of driving season, I mean, we're already there, really. Any concerns there? And we've got pretty healthy oil prices. I know that obviously you just said, the concern in the US in election years to keep inflation down, to keep energy prices down. If we see prices inch up, do you think that Joe Biden could dip into the SPR mechanism, if you like, or not?
Well, I think there's always a temptation to play politics with some of these factors, but at least in the U.S., the SPR may be a tad more political. I think interest rates are set by a fairly independent group, and I know that the administration has expressed their view that rates will come down, but so far that's not happened. And my general sense, though, on this question too, is we do in America have this sense that gasoline prices are a factor that can feed into the political cycle. But if you really go back and look at the data, there's a election forecasting model you can basically run, and some of the factors that really weigh into the outcome of the election would include economic growth, a whole variety of factors. Gasoline prices, as much as folks would say they might be a factor, they don't tend to be. So my general sense is that folks will be talking about it. It's topical, but I don't know if those things will really feed into kind of how the government officially acts, or whether there'll be extreme political pressure to make changes to the general political and economic setup of the U.S. prior to November.
Yeah, and there's the bigger questions for the government to answer, I think, at the moment. Ram, just back to you. Let's talk a bit more back to sort of a bit of Russia, because I want to ask you about India's intake of Russian crude. Last year we had record intakes by the country. Of course, the discounts have moved and changed a bit. What's the first quarter been like, and what's the outlook for India to still take, Russian crude, which is at the end of the day still cheaper than what else is out there?
Yes, certainly. If you look at the data, like Russia, I think went up, Russian crude went up as high as 45%, dipped down to 23% to 3 or 4 months back because the discounts have changed. Again, when I look at the numbers, it has inched up again to around 32-33%. Obviously, the biggest factor is the prices, the discount. There have been two major issues. One is the shipping issues because of some ban on some shipping companies. That is number one, which played truant in between. And the second issue has been the payments mechanism, the rupee to ruble payment mechanism, because India has got a huge trade deficit with Russia. So that was another issue that played truant. But nevertheless, all the refineries are pretty happy taking Russian crude because of the prices. But what has also happened is, since the discounts have gone down, the gross refining margins of most of the refineries, like which was very high numbers have come down, maybe come down by around something like 30-40% or so, maybe more than that. But if you look at the absolute number of this gross refining margins of most of the refineries in India, it's still pretty healthy numbers. Like yesterday, India's leading private refinery also, they came out with the results. Still, it's at a healthy number of $12 to $13 per barrel of oil. So therefore, net is Russian crude will continue to flow into India as long as the discounts continue. All the some irritants which has been there in between, I think it will be on and off, but I think we will find a way around it. And third point is everybody is happy, like the refiners are happy because they still make a good amount of profit. The Indian government is happy mainly because we're taking more of Russian crude. They've been able to bring down the oil import value, so which has reduced the subsidy which they have to give to the different other people. And thirdly, on a geopolitical front, India seems to be at par with both Russia as well as with the US. Especially India needs to be at par with Russia mainly because of the China factor also. So I think net all this is I foresee Russian crude will continue to flow into India as long as discounts continue. The numbers can vary between, let's say, 30 to 40%. But beyond 40%, as I said previously also in this particular talk, there'll be a sort of upper cap limit to the amount of crude that Indian refineries can take. So that's what my outlook is for Russian crude.
Okay, thanks, Ram. Johnny, let's talk a bit about, again, sticking to Russia, but about shipping. We've seen since the new year stricter sanctions by the US on insurance, etc. And now we have an article today, for example, Sweden proposing to the EU that it sanction Russia's shadow fleet and ban its LNG, etc. Getting stricter on Russian flows. What's the outlook, do you think, of that? That really isn't the intention, is it, of the sanctions initially? The world still wants to see Russian crude flowing. Do you see this year that we will see any difference than last year in terms of, sanctions actually impacting the bottom line, if you like, on global flows?
That's a very good question. There have been masters of navigating sanctions, and a couple of examples are still within the market. I do believe that volatility is here to stay, but at the same time, if sanctions do continue and are implemented or impacting the market further, there will be a rerouting of flows. Plain and simple. The whole reason is, the world, the refining system needs crude, and the types of crude that are produced in fairly large quantities and volumes and of the correct quality are impacting or the ones that are being impacted by sanctions in the most sense. So, I think there will be a rerouting of flows. There will be secondary markets, as we mentioned, with China and taking Iranian crude through the Malaysia mechanism, but also for, Russian grades to come onto the market. If not, we do see some definite price upside potential to crude. But of course, coming into what we're looking at right now in terms of the yield percentage and yield cuts of these types of crudes in performing and producing the middle distillates of diesel, gasoline, and jet, which are all set to pop off, which are all set to increase in demand through the next couple of months. That's the primary reason. We're coming into, this is the election year. Most governments, most parties would not want to see extremely high prices at the pump. So there has to be a mechanism to allow for these crudes and products to come onto the market.
Okay, thanks, Johnny. Rob, just back to you. Let's take it a bit broader into other commodities versus oil, whether we're talking about gold, silver, of course, which have had a bull run the last few weeks or even months, and other sort of precious metals. I mean, are you and then yet we have another headline today in our news bulletin, which says how, the financial side of the oil bulls is now looking at possibly shorting again, having been quite risk on. I mean, it seems to be quite a confusing picture, doesn't it? And especially when you take at how commodities are, sort of running together. We're seeing that what's happening with the dollar, what's happening with gold. Is the market making any sense of this? Is there confusion in how these various different risk assets are behaving against each other?
Yeah, I mean, I think generally I would caution that, you obviously pointed out, gold has been on a run lately. We have our Bloomberg Commodity Index, which is tracking a basket of commodities that includes oil, energy, the precious metals, and that index has been rising over the last couple of months, but it's down off of highs from roughly a year ago. So we continue to see flux in all commodities, and I generally would say that even though I don't spend much time going deep on gold or silver or any of the precious metals, my general view is that each commodity really does tick to its own beat, and so I wouldn't read personally a whole lot of relative view from what's going on in the oil market or the gas market. I generally see these things as sort of unique and distinct, and I prefer to default back to the fundamentals. So I wouldn't read much from what's going on with gold to think about oil here in the moment.
Okay, thanks, Rob. There's our survey question for today. US sanction on Iran, even if enforced, and of course we're hearing about the threat of sanctions, but many people say they may or may not be reinforced, and even if they are, wouldn't have a material impact on current oil balances? That's the question today. It won't, because what is the strongest of these three reasons? China takes most of the oil anyway, and the assumption there is that it is not going to be impacted by it's not subject, let's say, to the Western sanctions. It's not imposing them itself. Plenty of non-OPEC supply anyway, coming onto the market as it did last year. That's continuing, and OPEC Plus itself has spare capacity to release at any point that it so wishes to do. So which of those three would be the strongest reason why we would feel that Iranian sanctions, renewed sanctions on Iran, wouldn't have an impact? Ram, let me go to you on that in terms of, OPEC, it's not necessarily that you are the OPEC expert, but in terms of that sort of conglomerate of suppliers on which India and Asia rely on a lot, as well. They've been put in a quite difficult position, haven't they, coming up to their June meeting now? You've got the uncertainty around demand and what's that really going to be in the second half of the year. Certainly so far, it's been not necessarily what was expected 3 months ago. And then they have to be dealing with this non-OPEC supply from America, from Brazil, from other and even countries within their own organization who are not under the cuts agreement. Do you think they'll have a more difficult time this year navigating how they want to manage the market? And what is their top priority? They must retain prices above $85, considering budgets, etc.
Yeah, exactly. I think one of the major things that's playing in the commodity market, even if we leave apart oil, any other commodity, is what's the kind of uncertainty we're seeing in the market. So I think if you look at from OPEC perspective, one thing is they have to get the demand figures right. China, and everybody thought China numbers will be pretty flat. Sadly, there are news that China will go up. And second thing is the internal dynamics within OPEC itself, with OPEC and an extended OPEC, as I would call, and the way Russia plays its game and all. That is number one. Number two is you're right about the non-OPEC supply. One of the major reasons of the non-OPEC supply has been from USA. And the major reason why USA supply has gone up is the increase of productivity of the different wells from USA, which I don't think anybody expected out there. And the third thing is about what is going to happen in Venezuela. So Venezuela and other countries as a whole. So now coming to your question, like OPEC today, one is, of course, they have to manage the sort of situation among themselves, like, Saudi versus Iran and other countries, and Saudi versus Russia. And second thing is, like, of course, the demand being a little bit it's very difficult to fix the demand figures right now. And the third point, which I keep saying, not only in oil and other commodities, what the kind of geopolitical shock that we are seeing, which is totally unforeseen. Like 6 months back, when this present war started, like I personally was of the view that will end within a couple of weeks, but it's dragged on and it's become much more it's become a multi-dimensional thing. So therefore, it's very difficult to put a fix to when and what exactly is going to happen. So frankly, like you're right, if I were in OPEC's place, it's going to be a tough time to do and tough time to work for. And I think the only thing which they can do is right now take the situation as it comes by maybe 2 2 months or 2 to 3 months, 1 quarter to quarter, then only they can make the strategies and not have a permanent strategy in play. Like, we'll be cutting oil, we'll be cutting the output, or we can increase the output, something of that sort. So it's something which we call as a situational planning, as we've seen in the commodity business. That's what I think OPEC should be looking at doing, which I'm sure they are trying to do right now.
Yeah, which they've been doing really. I mean, it has been their policy, hasn't it? Rob, just very quickly back to you on the US production side. As Ram was just mentioning, at the end of last year, we had this sort of commentary on, it surprised everybody, the actual finals of total production that came out of the US last year. Is the sentiment still this year that was a one-off, really, and things are going to sort of, I suppose, plateau? Are they plateauing, and and why, essentially, in terms of the policy that the various companies and operators are in that field?
Well, I don't think policy is a big factor. If you somewhat believe the headlines, you would think that something on the political level would be holding back production in the U.S., and in fact, that's just not the case. I think the continued output performance of the U.S. has been surprising to many observers, and I do think that our general take is based on looking at kind of rig activity, kind of what companies' plans are. I do think that we don't expect another repeat of U.S. output really surprising to the upside with just continued momentum. So maybe the U.S. And I'm not saying it's flat necessarily, but I think will the U.S. deliver another stellar year in terms of U.S. output growth? Our belief is that probably not. And let's see how it unfolds. I mean, the U.S. industry has surprised us in the past, and I think the shale producers certainly they're continuing to be active. It's just what amount of incremental supply will they deliver? Yeah. And my sense is that it's probably more moderate than in years past.
Okay, thanks, Rob. Janiv, is there any, just back to sort of sanctions, but the impact and sentiment by shippers? More talk of sanctions now, repercussions on trade flows because of, for example, Venezuela may not get its sort of little reprieve to export more oil. How that filters through in terms of ships available for other routes, etc. Is there more nervousness and uncertainty in the shipping community, if you like, in terms of the rates they're going to be charging or not, and sort of the volatility on that front? Has that become a bigger question mark this year because of the geopolitical tension in the Middle East, particularly?
I mean, look, the pinch points within the global sense, looking at the Middle East and the Bab al-Mandab Strait as well, has increased the ton miles and then the consumption of these types of fuel oils, right? So in terms of what that means for demand, it calls for a higher yield of refining to produce these types of finished products. And we're looking at inefficiencies in trade flows, rerouting through, around the Cape of South Africa, instead of going through the Middle East, in terms of flows of crude and products from Asia, or the Middle East Asia side, towards Europe. You've got another element to discuss here as well, is the inclusion or the expansion of the Trans Mountain pipeline, which is taking flows of Canadian crudes away from the pipelines that went into the Gulf Coast in PADD 3, but to the West Coast, and then export of these via ships. So an increase in terms of a call-on vessel availability towards the rest of Asia and maybe even into PADD 5. There's another element here in terms of decreasing the amount of vessels available or vessels required in terms of demand. You're looking at the Mexico crude export cuts, partially for fueling their own refineries, but also in preparation for the Dos Bocas refinery, Olmeca refinery, coming online later this year. But no, look, there is a lot of volatility, but as we head up into the demand season, in terms of products, this is where the flows does come to the forefront and becomes a lot more important for the global market. But of course, this type of a cost is likely to be passed over into the refiner and to the end product use demand holder.
Yeah, and users will be taking the brunt. Thanks very much, Janiv. There's the answer to our survey question today. So the China element seems to be getting the most votes, unsurprising perhaps. It is not subject to agreeing with what sanctions are being put on Iran, and so yes, our audience agrees that it's not going to have a huge impact, and of course that comes on the back of last year. The US ignoring the fact that Iran was defying whatever restrictions were already in place. We didn't talk about how OPEC as a group feels about that going forward, but that's we can save that conversation for another day. Thanks so much to Rob and Janiv and Ram for joining us today, and have a great remainder of the day, everybody. All the best.
Thank you.
Thanks all.
Thank you.
Thanks, everybody.
Great day.